All right, so in this session, what we're going to do is get into a whole new risk. We've hinted at this risk in the past, credit risk. We talked about with your banks and your risk management, credit risk can fall under credit risk or under price risk, depending on how they define it. So I'm defining credit risk as a risk that someone who owes you money fails to pay you. They've gone in default. Some of your banks define credit risk as both default risk and they may include something called downgrade risk. Some banks put downgrade risk as part of price risk because a firm is downgraded, say from triple B to double B. When they're downgraded, their bond price will fall, but they haven't defaulted. They're still paying you money, but you have a price discovery there where the bond price falls because of the downgrade. I would put that under credit risk, but there are some people who put that under price risk. So you have to read very carefully with your bank where they put downgrade risk. My definition is a little bit more structured to actual bankruptcy, but I'm open to that. We talked above about liquidity risk and tried to distinguish between a liquidity crisis and a solvency crisis. So right now we're seeing airlines and cruise lines really struggling. Is this a solvency issue? Are these firms really out of business? Their business model have failed. They'll never come back. Or is this a temporary liquidity issue? They just need some government loans to hold them over, and then they'll be fine. So that's the definition, and it's important to distinguish between a solvency issue and a liquidity issue, whether it's a permanent issue or a temporary issue. That's definition. On the measurement, credit ratings is the most popular way that we do the measurement. And I have down below on page 29 some definitions from S&P and Moody's that they define their rating system as the likelihood of default, what are the provisions and the natures of the actual debt itself, and what protections are there. So you're thinking about things like collateral and who gets paid first, those type of things. And then your credit ratings, you have high quality ratings, AAA, AA, and I would even include single A and high quality. You have your medium quality ratings, which are the triple Bs. And then you have your below investment grade ratings, which is double B, single B, and the C's, and then of course the D for default. You can see S&P's definition of a AAA is extremely strong capacity to repay, then very strong, then strong, and then for triple B to have the word adequate. And once you get down into speculative, you start seeing issues. This firm, double B, they're probably going to survive unless we go into a major financial crisis like we are right now. So double Bs do well unless there's a crisis. Single Bs are even more susceptible to a major crisis. Triple Cs, double Cs, and single Cs, they're not expected to survive, but if they get some luck or economy turns or something, they might survive. And there are several firms that fit into that category. And then the D, those are firms who have missed a payment, either an interest payment or a principal payment. So there's your definitions of the credit ratings. You can use other things. Altman Z, you can look up Altman Z in Wikipedia, and they'll give you the actual formula there. That's a good formula for figuring out if a firm is near default. Once you get above a certain level, like if an Altman Z score is like 10 or 11 or 8, a 10 is not necessarily all that much better than an 8 or a 7. It's when you get down close to the 1s and the 2s where you get into that danger area, that's when it becomes predictive. So it's more predictive of actual default than it's predictive of high quality versus medium quality and low quality. That's very different than Bloomberg. Bloomberg has something called probability of default, and Bloomberg's probability of default has a high correlation to credit ratings. Altman Z is somewhat completely unrelated to credit ratings. So it doesn't help you distinguish between high quality and medium quality, whereas Bloomberg's probability of default does a good job of distinguishing high quality and low quality. And if you look at Bloomberg's classification, they will even use the terminology, high yield, investment grade, and they have different scores. And I've tested those, and they are actually have a fairly decent overlap with credit ratings. The nice thing about the Bloomberg default probability is that there are a lot of firms that do not have credit ratings. If they do not have publicly traded debt, they won't have a rating from S&P or Moody's. But Bloomberg does give a probability of default for all companies. Altman Z does have a number for all except for financials. They don't do banks and insurance companies. So I think if you're looking for something, you need it for thousands. You're going to bring in 1,000 companies, 2,000 companies. I think the Bloomberg probability of default might be your best number. So real key with measurement is you need to distinguish between frequency and severity. Frequency is the probability that the firm will default. Severity is once they default, how much will you recover? So severity is somewhat 1 minus your recovery rate. So you might have a 1% chance of default, but then if they default, you'll get 40% of your money back, which means you'll lose 60%. So you have a 1% probability of default, and when it defaults, you'll lose 60% of your money. So your expected loss is the probability of default times 1 minus your expected recovery rate. The spread that you get from the bond, that extra that you get over the risk-free rate, is what you need to cover this expected loss. So let's look at something I have for you on Blackboard. It's this average default rates. These are just default rates. They don't adjust for recovery rates, which is very, very important. But it goes to 2012. If I could find this more current, I would, but at least it has the 2008 crisis in there, which is important. And what they do is they show you a cumulative default rate. So after 1, there's no AAA firms that have gone in default. Just a very small number after 1 year that's going in default on AA. That might be Enron. Enron was actually AA rated the year it went under. And as you can see, as you go down the line, the probability of default gets higher and higher and higher. What I would focus on and what I do on the exam, and I'll give you a practice exam problem for this to help you get ready, I would look at the 10 years. So look at the 10 year. Over 10 years, 0.87% of AAA bonds have gone in default. That's over 10 years. So you're not going to lose 0.87% a year. You're going to have to take that 0.87% and divide by 10, and that gives you 0.087, or about 9 basis points. So essentially, with the AAA bond, you expect a credit loss of about 9 basis points per year, which means if your spread on the bond was 9 basis points, if you're being paid 9 basis points over treasuries, and that's your spread, you get that spread every year. So over 10 years, that extra spread will add up to 90 basis points, but you expect to lose 87 basis points to defaults. So 9 basis points would be adequate to cover your AAA risk. And remember, this is only default. AAA bonds, your recovery rate might be 50% or higher. Let's say it's 50%. So if your bond only paid you 4.5 basis points over treasuries, that would add up over 10 years to 45 basis points. You expect defaults of 87 basis points, but you expect to get half your money back. So that's about 42, 43 basis points of loss, but you got paid 45. You can see you don't need much spread to cover you for default risk on corporate bonds. When you get down, and I would memorize these numbers. For AAA, it's about 1%. AA, 2. All right, I print this out and just carry it around with you. I think it's a great table just to show you how much riskier bonds are as you go down the credit rating. When you get to AA, you're getting to about 7% of loss over 10 years. That's still only 71 basis points you need per year on average to compensate you for downside risk. And again, that ignores recovery. Recovery rates for BBB are probably lower than for AAA, but they're not horrible. They're not zero. You know, even on Enron, people who invested in Enron, they got some of their money back. And so, 71, 72 basis points would cover you for just the fact that they went in default, and then you're going to get some of that money back, maybe 40% back. So that gives you some idea of how much spread you need. Then you see a big jump when you go from BBB down into the speculative bonds. you see a huge jump. You can see on the triple C, over half of those will go in default over the next 10 years. About a third of single Bs, about 20% of double Bs. If you look overall, investment grade, it's about 5%. Speculative, it's about 30% over 10 years. And so you get a good sense of how much you need in spread for these bonds to compensate you. Now, what I also gave you is a file showing corporate bonds option adjusted spreads. We do not have time to talk about OAS in this class. If you're taking the fixed income class with John Toohey, he'll probably get into OAS. I do recommend on OAS that you look up OAS. OAS stands for option adjusted spread, which is really the true credit risk spread for bonds. It takes out any kind of callability, if a bond can be called early or if it's prepayable, takes that out of the spread and just shows the spread just for the credit risk. And if you look at this over time, I've got about different types of bonds. I know it's hard to see. I can't really blow this up without messing up the screen. But you have AAA, AA, single A, triple B, and high yield. You can see the 2008 crisis. Pretty incredible. The high yield bonds had spreads. These are spreads of like 20%. That's what you'll make over treasuries if you bought those bonds right there. But then you have to take out defaults out of that. So if you look at AAA, just AAA by itself, you can see AAA by themselves have given you a spread of about 25 basis points on average. Even they jumped up really high in the 2008 crisis. But remember, 25 basis points, if you're buying a 10-year AAA bond, it's going to pay you an extra 25 basis points over treasuries. But your losses are, you only have defaults of about 9 basis points. And you'll probably get half of that back. So 4.5 basis points would be more than adequate. And yet this bond is paying you 25 basis points. That's pretty good. If you look at triple B, remember about 7% of those defaulted over 10 years. So if you look at them, 7%, so you need about 71 basis points, and that's just for default risk. That doesn't include reducing that for recovery. But these bonds pay you on average about 174 basis points in extra spread. So you're getting compensated very, very adequately for these bonds. But at the same time, when you have a year like 2008, boy, you better be ready. That's not default risk there. That's the downgrade risk and just credit spread risk. And then high yield, obviously high yield just went off the map in 2008. So this is a good chart just to look at some of the history. I would have updated this for 2020, but I don't have access. Unfortunately, I don't have access to the Bloomberg terminal. All right, so I'll show you a problem. Like the key here is you look at the 10-year default history. So for triple B bonds, we saw that was 7.11%. So about 7% of them default over 10 years. You divide that by 10, so you see what the average is per year. That's about 71 basis points. You look at the recovery rate. So that 71 basis points will more than cover you because you might get 40% of your money back. So you reduce that 71 by the recovery rate, by the 28%. So maybe that comes out to be 40 basis points, 50 basis points. You compare that to the actual spread on the bond. Maybe that's 170 basis points. And on the exam, I just want you to do that math. Say, on average, I'd need about 45 basis points a year to cover me for the default risk minus recoveries for triple B bonds. I'm getting paid 174 basis points, so I'm getting well adequately compensated for default risk. What you should put in your answer is that default risk ignores the downgrade risk. So remember that 174 basis points is covering both default risk and downgrade risk. And so is 174 basis points enough? It's more than enough to cover you for default risk. However, there is some volatility, and especially in a crisis like 2008 and what we've seen here recently, these bonds can fall even though defaults haven't gone up yet. And so you have to cover that extra risk. So if your probability of default over 5 years is 5% and your expected recovery is 40%, then the minimum spread you should get is the 5% divided by 5 years times 1 minus recovery rate, or you need about 60 basis points a year. You'll do that math on the exam and then compare it to the actual spread, which might be 150 basis points, and just let me know your opinion. It's really just do the math and then give me an opinion that shows you understand what the numbers are doing. All right. One other issue here is something called price discovery. I do want to bring in price discovery into the discussion. So the next video, I want to talk about the mitigation strategies for credit risk. Hopefully you're seeing some of these in your bank paper. And then I also want to talk about price discovery. Oops. So we'll start there next session.